For decades, China's rise seemed unstoppable. Is this the end of an era or the dawn of an entirely new one? Hey everyone, and welcome back to our channel. Today, we are going to take a look at China. China's economic trajectory is undergoing a profound transformation. After years of investment-driven growth and export-led expansion, diminishing returns and shifting demographics are forcing a strategic pivot. Policymakers now emphasize domestic consumption and local innovation to build a more resilient and self-reliant economy. Technological advancements from AI to green tech are now positioning China as a formidable global competitor. Yet, the transition to a consumption-led model remains uneven, and geopolitical headwinds are intensifying. Today, I want to explore how China's evolving growth model, technological ambition, and shifting global alignments are reshaping its role in the world economy. By the end of our video, you will have a complete overview of where China's economy actually stands today. In the face of an increasingly polarized international environment and an intensifying US-China rivalry, China is undertaking a decisive pivot away from its long-standing export-driven and investment-heavy model toward one that actually focuses on domestic consumption and stabilization. Let's hear next from our expert, David Bourne, on what he's seen in China today. David, what are the things that you're seeing?
China is currently undergoing a structural transition from an investment-driven growth model to a consumption-driven growth model. In the past, growth was driven by investment into the real estate sector and the manufacturing sector. The real estate sector has been deflating a lot over the past years, so consumers see themselves burdened with high debt and low asset value, and they are very reluctant to consume. At the same time, the investment into manufacturing has built up huge capacities, which now have trouble finding the right demand.
Interesting. So do we need the consumers in China to buy more to consume that demand?
Exactly. That would enable that transition to a consumption-driven growth model, but given the high debt, people are keeping their money together, and at the same time, the overcapacity leads to deflation.
Interesting dynamic there. And what can really be done then to fix this deflationary period?
We see two things that are going in China's favor. One is that the government has started to act by subsidies, by tax cuts, but there's an even more important factor at play here.
What would be an example of that?
We all, I guess, remember the DeepSeek moment when China released an AI model that was just as good or even better than the models previously released by US companies at a fraction of the cost. And this is just one sign of the great innovative power of the Chinese economy, also driven in part by the tax sanction put in place by the US administration under Joe Biden.
Interesting. And if history repeats itself with China and innovation, I have to believe that this won't be the last time we have a DeepSeek moment out of the region.
Definitely, China will be a force to be reckoned with regarding innovation, but still they will be needing to solve the structural issues we have been talking about.
Thank you very much, David, for sharing the insights from the Roland Berger Institute and for joining us today. By 2024, China had emerged as the global leader in 57 of 64 critical technologies, surpassing the United States in the breadth of its innovations. Despite geopolitical tensions, China's rise up the technological value chain is not only proving resilient, but is also accelerating. Faced with structural headwinds at home and rising geopolitical pressures abroad, Chinese companies are accelerating their model of globalization. What began as a simple response to an earlier wave of deflation and tariff shocks for Chinese solar PV manufacturers in 2012, for example, has developed into a comprehensive localization strategy. China no longer sees itself as the world's workbench, but rather as a global presence in supply chains, factories, research and development, and brands. The 2008 financial crisis marked the beginning of China's M&A-dominated foreign direct investment. Meanwhile, the 2012 PV anti-dumping tariffs sharply accelerated China's shift toward greenfield FDI to bypass trade barriers. The US-China trade war, which began in 2018, had already prompted many Chinese firms to shift production to countries such as Vietnam and Mexico to avoid tariffs and maintain access to key markets such as the United States and the EU. The need for supply chain resilience was further reinforced by the subsequent COVID-19 pandemic, while ongoing trade tensions further incentivized Chinese firms to invest abroad. Chinese companies are adapting to localization requirements and customs barriers by investing in production centers across Southeast Asia, Europe, and the Americas. For household appliances, electronics, electric vehicles, and clean energy, cross-border platforms like Temu and Shein are reshaping global e-commerce, while industrial giants in the renewable energy sector are establishing vertically integrated supply chains abroad. Amid a prolonged period of producer price deflation in a tightening global trade environment, the imperative to sail out or sell out has become more urgent. Chinese companies are now drawing on lessons learned from Japan's lost decades to secure their future growth through strategic globalization. We are excited to see what this new China might look like. We're joined now by Global Managing Director Denis Depoux to share his insights on what's going on in China. Hey Denis, what are you seeing in China right now?
Well, the themes for foreign investments in China are changing. China is certainly not losing its status as a global factory, but that is changing and diminishing. And also, China is undergoing a slowdown of its economy. It's still a very big market. It's still growing, but segments might be a lot more volatile. And it looks a lot more like our economies where you have cycles. And that's quite new to China. But yet it remains a big market. So for a foreign investor, if you're not in China, it might be a good time to come, but with a different mindset to maybe capture technology in China, bring into the rest of the world, learn from China, not only to serve the Chinese market or to serve the global supply chain. If you're already in China and you're very big, you might think of becoming a bit smaller because that level of competition is unsustainable and maybe being more focused works well. If you're small in China, you might think of either getting bigger, if possible, or exiting the market because you're not going to survive this level of competition in a market that is slowing down.
Thank you so much for joining us today to learn a little bit more about China. And as always, don't forget to subscribe to our channel.